Hello, everyone. We've got about 2 more minutes before I'm going to get started. Just know that tonight we are going over Credit 101. So, this is going to be really the basics of building credit and maintaining it. So, it's really going to be for maybe your young adults, teenagers, or people that are just getting out there and really trying to build credit so that they can make a big purchase down the road and be on their best footing. So, give us about 1 minute and we'll start and go over Credit 101. Looking forward to it. If anybody has any questions or things that you want to make sure that I cover, please make sure and throw that in the chat for me. Should be getting chats from both Facebook and Zoom. So by any chance I miss it, give me just a moment because I am trying to monitor 3 different screens here. We're going to see if I do that okay today. We're going to try. All right, everybody, it is 6 o'clock. So let's get started. Let's talk about credit, how to build it, and how to keep it at its very, very best. So let me get in here and share. All right, so let's just start with why we need credit. This is an important thing. It's a proof of financial responsibility. So when you are doing something like buying a car or buying a house, the lenders that are going to lend you very large sums of money often need to be able to look back and see that you have been responsible with credit in the past. Before you do a great big purchase, like, I don't know, a $200,000 loan to buy a house, it's important that you have some history of borrowing and paying back. It shows some trustworthiness, right? So I think it's very important to remember its responsibility, the ability to respond to things that happen in your life negatively, right? Bad things happen to all of us. How did you respond to that? And how were you financially able to make sure that you made the payments that you promised to someone in the past? And that is what lenders are looking at when they're looking at credit. So let's go over the basics. You've got the good credit, right? Good credit is going to be things like an installment debt. These are things that help build your credit score and give you beautiful credit in the long run. So you've got your mortgage, vehicle loans, educational loans. Those are all installment debts. So to think of the difference between installment and revolving, it's really easy. Basically, installment is you borrow money and you have a fixed payment every month until it's paid off. You can't borrow more against it without getting a new loan. Whereas revolving is like a credit card or a line of credit at a furniture store where you can go and you can buy a little bit here, pay down a little bit per month, and then go buy a little bit more. And that balance is revolving. It goes up and it goes down. Right? So those are revolving. So those can be good credit. Now, installment debts are going to be the foundation of good credit, and revolving debts just add a little bit of extra. Also, something to note is overdraft protection accounts that are done through your bank. A lot of times, those are just small lines of credit. So if you use those, you might actually be building credit if you've got a bigger bank that does report to the credit bureau. So then there are things that are reported to your credit that are bad. Some of these are pretty make sense, right? A collection account. A collection account is a debt that you did not pay, therefore it went to collections, and now they're expecting you to pay them back because you are in default, right? It's a negative, it's a scar against your credit. Late payments, charge-offs. A lot of people ask me, what's the difference in a charge-off and in a collection? The difference is a collection, they're still collecting on the debt. They're going to call you, you're going to get a gazillion phone calls trying to get you to make a payment or set up some arrangement. A charge off is they've given up. So they've charged you off. That doesn't mean that that debt still isn't out there, but they're not trying to collect it up anymore. And that does make a difference when it comes to some loan types, just FYI. But both of them hurt your credit score. So remember how I mentioned that revolving can be good and bad? We're going to get into this a little bit deeper as we look, but I just want to show you that credit cards can be good if you use them wisely and you don't use too much, but they can be bad if you are really high on the balance of that credit card. So if that balance on the credit card has a $1,000 limit and you have charged $900 on it, that can actually hurt your credit rather than help it, even if you pay it on time. Believe it or not, having no credit can be bad. And I'm going to get into this a little bit deeper because a lot of people, especially in this day and age when a lot of us are trying to keep our debts at a very low minimal amount, we don't want a 24% interest rate credit card, right? Scary, scary how much interest is on credit. So no active accounts can give you no credit score. And remember, as a lender, if we're going in for a large loan like a car or a house, they need to see some responsibility. So there are ways around that. We're going to talk on that in just a moment. But know that having no credit, even though it doesn't seem bad, it can be a negative when when you're trying to utilize that credit. And then the ugly. So I decipher the difference between the bad and the ugly as the bad you can work on and get your credit score up and still buy. The ugly are things that even if you work and you get your credit score as high as possible, until your timelines on the ugly have passed, you may still not be able to utilize credit to buy things like a home. So let's talk about like bankruptcies. A bankruptcy, there is a specific timeline. Even if after your bankruptcy, you built credit and within a year you had a 700 credit score, which believe it or not is possible, there is still a waiting timeline, regardless of what your credit score is, that is based on that bankruptcy timeline. Same goes for judgments. Foreclosures are really tough. There's a long timeline for foreclosures typically, and mortgage lates. Even if you had great credit, but you had a couple mortgage lates and those are recent, it doesn't matter what your credit score is. Those mortgage lates are going to affect your ability to utilize that credit specifically for buying a home. And when it comes to buying things like automobiles, it's just going to affect how much that interest rate is going to be when you buy that automobile. And student loan default. So tax and student loan default, the IRS gets theirs. So just know that even if you have 800 credit scores, if you owe the IRS or you owe the government for student loans, you're probably going to have to get that under control before you go and buy a home. The reason for that is most home loans, all of your traditional home loans are backed in some way, shape, or form by the federal government. And what better way to make sure you're paying your government bills than to make that a requirement of using their loans? Makes sense, right? So let's talk about the difference in something like Credit Karma or Experian.com, where you are constantly able to see your credit. I have a lot of people that say, I know my credit score, I looked at Credit Karma. An amazing tool, by the way. I love it. I get one through my credit card. They tell me what my FICO credit score is, right? So when you're getting something that is through a system that is generated without doing a hard credit pull, they are just doing a look at the accounts through a system, they're coming up with their own system of doing a score. And I want you to notice that their system is slightly different than what is actually used for a mortgage. So this would be like the Vantage score versus the FICO. You're going to see that, for example, payment history is 35% on your FICO and it's 46% on your Vantage score, which is what you're getting for like Experian.com or Credit Karma. So if you paid everything on time, but let's just say your credit utilization was actually higher, notice that the credit utilization on Credit Karma is not hitting your credit as much as it does on a really hard credit pull. And a hard credit pull is what a lender is going to use when we are actually pulling credit. A mortgage credit pull is pulling through a direct credit hit, true credit hit from all three bureaus with a FICO score. So that is why I say absolutely 100% get a nice credit monitoring. There's tons of free ones out there. Don't have to pay for it. Most credit cards come with it. Your bank office a lot of times has it. But just understand that it is a great way of knowing if your credit has gone up or down or stagnant, or if there's something new that you don't know about, to make sure nobody's stealing your credit. That's important. It happens. But know that it is not your actual credit score when it comes time to actually buy or make a large purchase. So let's talk about building credit. And real quick, before we go here, I just want to talk about why it's important to build credit. Because yes, 100%, we as lenders have ways of getting you mortgages. You can buy a car. You can buy things on credit without having a credit score by doing things like utilizing alternative trade lines, things like utility or rent. Utilities aren't on your credit bureau, and neither is rent Typically, some big apartment complexes have actually started reporting, but most of the time that is not on your credit. So as a lender, you could come to me and say, I have zero credit score. I've never built anything. I do everything via cash. And I could go and build an alternative trade line for you, a couple of them, to get you qualified with a mortgage. However, the interest rate on those are not going to be as good as if you had done just a couple things to build a credit score. Very wisely, mind you, I am not telling you to go out there and go into major debt. Please know, Charlotte does not tell her kids that. She does not do it for herself. You don't go into major debt to try to build credit. It's a bad idea. But you can take a couple simple steps and build your credit. And then when you go to buy a car or buy a house, instead of getting hit with a risk score because you don't have any traditional credit, you're a risk interest rate, a higher interest rate because you don't have any credit, you could actually qualify for a better interest rate. So let's talk about that. So the do's. We want to make sure that you are getting the most positive effect from your credit by keeping those balances low. So remember how I told you about revolving is a great way of building credit. And I also mentioned that if you have a high balance on that revolving limit, it's going to hurt credit. So keep it between 6 and 10%, just a little bit. So use the card, but pay that card off prior to the bill coming out down to 4 or 5%, not to zero. You can pay it down to zero after the fact, but get it down to just a little bit so we show some credit on that credit bureau. But again, remember, don't charge too much. If you do happen to charge a ton on that bill, make sure you pay it down to that 5, 6, 10% of the limit before the bill is generated. Did you hear that trick? That's an important one. Before the bill is generated. So with that, I just say, make sure that you know when your bill is coming out. So when the bill is generated, when that statement comes out is when they're analyzing your account to see what your balance is. So if I go and I spend $1,000 on my $1,500 credit limit card before that bill comes out on the system, before it is generated online, I want to make sure that I have paid that down to my 10% of the limit. So I've paid it down in that scenario about $150, right? So it's also really important that you make your payments on time. That's kind of a no-brainer, right? There's a couple of things here. So let's talk. Because some people think if I'm one day late, I have just messed up my credit beyond belief. And that's not exactly the truth. So what goes on your credit as a negative mark is if you are 30 days past due, 60 days past due, 90 days past due, or more than 90 days. Those are the brackets, right? So if you pay your payment that is due on the 7th, on the 10th, that is not going to report on your credit of the same month. It's due on the 7th of February and you pay it on the 10th of February. That's not going to report on your credit as a late. However, let's just be smart here for a minute because there are some late fees. So you want to make sure that not only are you not paying or getting hit on your credit score for being late, so within that 30 days is not going to hit your credit, but you also don't want to pay extra fees. That adds up. When you figure out how much you're paying in fees because you're paying a couple days late instead of being ahead of the game and getting your bill paid early, you're paying a whole lot more in interest on any debt that you have. So be smart. Pay your bill before any late fees and make sure you don't let it go 30 days because at 31 days, it will report to your credit as a late. No ifs, ands, or buts. Even if you thought it was auto drafted and then something happened and it didn't get auto drafted, it is your responsibility to make sure that auto draft happens. So it's your job to make sure that those payments did go through in a timely manner. Let's make that very important that it is your job, no matter what, it's your job to make sure the payments went through. So again, don't use more than 10% of the available limit on the card. If you do, pay it off or pay it down before the bill is generated. And don't apply for a bunch of accounts. So people ask me often if they apply for a mortgage, if going and shopping for another mortgage is going to hurt their credit. It's kind of a tricky answer. Typically, no. You can shop for the same type of credit over and over and over and over again and not have a hit to your credit. However, if in the last 120 days, you had a credit pull that was not around mortgage, let's say you wanted one of those store cards and got 15 or 20% off. know that that is now going to cause each one of those hits to ding your credit a few points. So the more credit types that you're shopping for within a 120-day window, you're really going to see that that credit score can drop. And if you happen to be shopping for a car, a credit card, and a house all at the same time with multiple credit pulls, and just know that auto companies are pretty notorious for pulling your credit a ton of times, honestly, to try to get you the best interest rate. But every lender they go through, they're pulling your credit. So a lot of times that does hurt your credit if next month you go and you want to buy a house. Now we have multiple credit pulls. So rule of thumb, don't pull your credit for a discount. It's really not worth it unless you just know without a shadow of a doubt, there is no chance that you are going to be needing to buy a house or buy a car or do any other type of credit work in the next 120 days. That is the rule of thumb. Obviously, don't run late on payments. And closing accounts, this is tricky. So yes, you can close some accounts that are not active. We don't want our credit to be hacked. There's lots of really cool ways that you can actually lock your credit, make sure it's not hacked. However, closing accounts can be detrimental to your credit. So it is important that one, you keep the oldest account open. Your credit depth is important, and how long you have had an account open matters. So I have this credit card that I would never use. Please understand, this credit card's probably at 26% interest, but I've had it since like 2009, maybe, I don't know, a long time. I've had this card forever. So I don't close it. I keep it open because it is a nice, deep, long credit account that I have had, and I don't want to close that and not let it count in my credit scoring. So keep your old accounts, and honestly, keep the account with the highest limit. So I also have a credit card that has why credit card companies give people these credit limits? Like, this is crazy. If I was not responsible, this would be a nuts thing to do. But they gave me a credit limit of like $60,000. I don't use that account. I don't use it at all. But I keep it because now I have a lot of open credit that's not utilized. Remember, credit utilization does go into your credit score. So that's why you don't want to close all of your accounts. But if you have 15 credit cards, you've got an old one, you've got plenty of utilization, can you close a couple of them? Yes, that's not going to affect your credit score typically. All right, so let's go back to starting credit and why we need to build credit. So we talked about the things that you can do to important when you're starting to build credit to make sure your score is high. Let's give you a hack. And I did this for my children, and I know lots of people that do. This is a nice way of quickly getting a credit score so that maybe you start off getting lower interest rates right out the gate when you're young. So I put my children on actually, I think one of them was on a credit card that I had opened since before they were born, but I added them as an authorized user. And please know, I did not give them the card. No way, Jose. I just added them as authorized user, which comes in handy for two things. One, that card oftentimes, and you want to make sure that the card that you're doing the authorized user does report the authorized user to credit. That's important. Not all of them do. Most of them do, but not all. So one, you want to make sure that if you add them as an authorized user, it is going to report on the credit bureau. And number two, if by any chance they ever had to go rent a car, you guys know that having a credit card is important, right? So I've actually been able to do this for my son. He didn't have a real credit card. He just had a debit card. He wanted to rent a car. They required a credit card. Bada bing, bada boom. I had one in his name because he was an authorized user. So that is a hack. And that basically, after a couple months of that authorized user account of reporting on the credit, it will boost your credit score. It will give you a credit score. So my children basically graduated high school with around a 700 credit score just because of that one trade line. Now, you're probably going to need some other trade lines, but that is a hack for getting on to just a quick buildup for building up your credit. All right, so real quick, I want to actually, before I get into this, when we're talking about building credit, there are a couple of ways that you can actually start building. And this is, I get this question a lot as well. How do I start when I have nothing? And it is a little tough, but a secured credit card through your bank, especially some of the larger banks, you want to make sure that they report to credit, right? But a secured credit card is where you give a couple $100s to the bank, and then that bank will then give you a loan of up to that amount in a secured credit card. Now they're holding your money in a savings account that is yours. You just can't touch it for a while they have the secure credit card open. And then you can spend as you want on your credit card. What that does is it gives you a way of actually building credit as you are, when you basically have nothing, because the bank is secured. If they're giving you a $500 credit limit, you have given the bank $500 to hold as collateral. So it is a way for collateralizing the banks in order for you to get a small credit card. So once, if you can get an authorized user, that's step one. Step two would be getting a secured credit card so that you can then pay just a little bit and just start building credit over time. It is going to take a few months for that secured credit card to really report and start giving you any credit scoring, just so it's not instant. So if I get the credit card in say March, then my first bill is probably going to come to me in April, and it's going to start reporting maybe mid-April, maybe May. And then you've got to have a couple of months of that reporting, depending on the credit bureau, before it actually generates a score for you. So don't be disheartened. It takes a little time, which is why you want to start planning this now. All right, so let's go into, and real quick, I'm just going to check my chat and make sure I don't have any. No, good, no questions. All right, so let's go in and let's talk about the date of last activity and why that's really important. So we talked about those credit card when you're not wanting to pay things off, right? So on top of not wanting to close and pay off your credit card sometimes, when you have something bad on your credit, like a collection, believe it or not, sometimes paying off an old collection does not help your credit score. So what happens is it starts over when the last time it had activity was, and so it's fresh on your credit rather than letting it kind of be old and stagnant. So what I will say about this is it really depends. It's very important that you talk to a professional. Let us do it, just even a soft pull on your credit. We can run a couple scenarios. And if you have a debt that you're thinking you might want to pay off, that's like an old, something from a past life that just got out of hand 4 or 5 years ago, an old collection, before you pay it off, especially if you're looking to do something like buy a house, come and talk to a professional. Let us look at it. Let us see if paying off the balance in that collection really helps your credit score. Sometimes it really just doesn't. All right, so this is something that happened mid last year. They just passed a rule that medical bills, this is wonderful, by the way. Every once in a while, there are new things that come out that are really helpful for our lovely credit people and people trying to build credit. So medical bills is something that we can't really control. When we got sick, we didn't ask to get sick. When we broke our leg, unless we were jumping off bridges stupidly, we didn't ask to break our leg, right? So those things are not going to hurt your credit like a medical bill, unless there's a couple of things here. It can go to collections, and collections, when they're in collections, they can hurt your credit score. Just know that the medical stuff isn't going to affect buying a house as much, because we're not looking at medical, but it does affect your credit score. So when it goes into collections, it can affect your credit score. But here's the beautiful thing. They've limited what can go on your collections. There's a long time that they have to send you bills before it can even go into collections. So they've taken the time. It used to be 30 days. Now it's up to 6 months. So it's really, really good that you have got lots of time before it can go into collections and hit your credit report. On top of that, this is the win. It used to be that if you had a credit collection that was a medical in nature, that even when it was paid off, it would just show as a paid collection, which really doesn't help your credit, right? Honestly, it sometimes can hurt it, because that whole thing that we just talked about with the date of last activity on that collection being more recent, it can hurt your credit. But with medical, they just changed it to where once that medical collection is paid, it comes off of your credit. Difference there. It's not showing paid anymore. It is actually coming off of your credit, which I think is super handy. It's going to help tons of people. We used to have to fight them and beg them to take them off the credit. It was really annoying. They've just got rid of all that altogether. If you get the medical bill paid off, you settle it, get it done, then it will come off of your credit. That is something that they have to do now. So that's great. That's a new medical update. So let's talk about the difference in poor credit and good credit and what that really means to you in dollars. This is big. So when I first showed this, it was to some college kids and we were going over and I was like, this is how much more you're going to pay based on your credit score. So you're going to see over here on the left that I have got the different credit score ranges, right? And then I've just got some national average for interest rates based on those ranges for a auto insurance, for a personal loan, and for credit cards. So we're not even talking big stuff like a car. We're talking about smaller loans. But look at this. If you had a good credit score, which is 720 to 850, then your monthly payment, national average, would be around 1555. Now, I want you to look that this is for your auto insurance. Because remember, auto insurance also takes into account credit scores, not just buying and using credit, but auto insurance does. They have a couple of things that go into it, but your credit score is part of it. Look at that. If you go down to a 680 to 719, which is still good credit, right? But you're going to see over a $200 a year increase in your insurance. Subprime 620 to 679, the average is about 1907. That's a very big increase. And then subprime. So if you're below 580, 619 or below, then that is really going to be where it gets tough. And that's where you have to go to a higher risk insurance company and payments are almost double. So twice as much for that. But then look at our interest rate averages for a personal loan. You're looking at 11%, 14%, 19%. And I want you to look on $10,000. The difference between a 680 and a 780 is $1,800 a year in interest versus $3,196. That's a big difference, right? That can really add up when you're talking about how much you're paying per year. And then let's go all the way to the subprime, and that's where you're looking at this $5,000 for the same loan. Instead of paying $1,800 in interest, you're paying $5,000 in interest. That you add that up over 10 years, and you're talking about a major investment lost because of credit score. So I did want to say that if you have no credit score, you're going to fall into the subprime area for most of these. So no credit score, it is doable. You're not all the way in the deep subprime. You don't have bad credit, but if you have no credit, you're going to be somewhere in this area. So just know that that's what you can look for if you don't. So again, doable. It's just not going to be as advantageous for you. Oh, real quick, credit cards. I mean, this is just blow your mind, right? So if you have a credit card now, and this is probably a little outdated because I'd say we're probably in the 20s now on these. Interest rate they just keep on going on. But $5,000, you're looking at about $2,240 on the 12.7 interest rates, what you're going to be paying in interest versus if you pay interest for a full year versus $69.86 or even $49.85. That's a pretty big difference. $2,200 to $49.85 is a pretty big difference for a 680 versus a 760 credit score, right? So you can just see how you take a couple of those because you're not just going to have auto insurance. You're going to have auto insurance, maybe a personal loan, maybe a car loan, and a credit card probably. And if you figure what that difference in you're paying out per year, this is the difference in being able to grow your generational wealth and or being stuck. So it's important that you work on that credit and do things to keep your credit score high and pay your things on time, right? It obviously goes way beyond. Another thing that I didn't even really think about, but it's true. When you're getting job applications now, I've had a lot of people tell me that when they go and apply for a job, they're also looking at credit. So that's another repercussion that if you're not responsible with credit, you might find that you don't get the job and or you don't get paid as much because they consider you a higher risk. It's important to know. So every point helps. So knowing your credit is obviously, if you want to know your grade in the class, you're going to want to go and look and see what your grades look like. You want a report card of some sort, right? So you're going to get that report card, which is your credit report, and then you're going to look for mistakes because please know, fans, there are some mistakes on your credit report. There are things that you could probably get fixed and help a couple points. So let's talk about how to get a copy of your credit report. So first, these three things, and I'm going to put this in the chat for everybody if you want to take this, if you want to screenshot your screen real quick. These are the three credit bureaus. All of them do have an online website, which is wonderful, or you can call and write to them if you find errors. Just know that when you are going to dispute something, you need to give the proof. You can't just say, this isn't right. Give the documentation around it and show the proof if it is incorrect. It takes a little bit of work, but you can do this online as well. So just know that all of these credit bureaus do have an online way of disputing credit. And then very important that you know how to get a copy of your credit report. So myannualcreditreport.com is the best way of getting your credit. That is in the chat right below. If you look at that, there are some companies, a lot of them, that are going to try to charge you for getting a copy of your credit. And I just want you to know that once a year, you can get a report from all three of these agencies at no cost. It's not going to give you a score. This is just your report card. But the way I like to do it is I'm going to get my Equifax at the beginning of the year, my Experian in the middle of the year, and my TransUnion in the end of the year. Because that way I can see if anything is new. You could get all three at one time once a year if that's just something on your calendar. Like once a year, I get a copy of my credit. You can go to annualcreditreport.com, get a copy of all three. They're going to make sure it's you. It should not cost a thing to get your free credit report. If you try to get the credit report and it starts to charge you, you are not at the right website. Go back, make sure you've got the website typed in, because let me tell you, they are tricky. If you put that in just one letter wrong, they're going to fish you and take you along to a website that wants to take money from you. So don't take money. That is something that you get for free once a year. And just FYI, here at Atlantic Bay, we do something called a soft credit pull. So if you were wanting to buy a house and just know where you are right now, you know, I'm just wanting to see where I'm at. I want to buy a house in the next, maybe 8 months, 10 months, a year. I'm starting this journey and I want to make sure that I'm prepared for it. We do something called a soft pull. So again, it is going to be very close to a hard credit pull, but it's going to give you a good idea. We can absolutely go through that soft pull with you, share with you if there's any tips or tricks that you can do to make sure you're on track for the timeline where you are wanting to buy. So please know that all of my mortgage bankers, they are very adept at this. They are amazing at finding ways to get a couple extra points. If you don't have credit, they're great at giving you a path to get credit. This is what we do. So please reach out to us. We would all be glad to help if you are on that journey, even if it's not today. That's okay. If it's a year out, we would love to get you started. We love when people come to us and they're prepared. So please know we're going to take those steps on the front end when it's early on and get you ready for home buying. So that is a lot about credit. So if we don't have any questions, and I'm not seeing any in my main chat, guys, I apologize. If you have questions on Facebook, please know I will go in and I will answer those questions after the fact. It is not coming through. Love live streaming. When your internet's not perfect, that's just the way it goes. Charlotte Harrell here at Atlantic Bay Mortgage. It has been a pleasure, and I hope this has helped you. Hey, share this with someone that you know, maybe somebody that's graduating from high school or getting ready to go out into the world, get married, and they haven't started this journey, or they've started and they've had a couple bumps. Please share this. I would love for this to go out, and we would love to help anybody that is looking to buy a home in the future. Have a great day.